I want to bring in Northlight Asset Management Chief Investment Officer Chris Zaccarelli. And Chris, what are you watching for? I mean, we had these big moves last night. We keep asking the question. We were just talking about it in the commercial break. Is the market overvalued? Are we frothy? What do you say?
Yeah, I think it's a great question. And, we've had a really good year in the market so far, and valuations are very high. If you look at, 20-year averages, we're towards the high end of those averages, a P ratio of around, 22.5 times earnings for the S&P 500. However, despite the fact that the market is expensive, it doesn't mean that it can't continue going higher. And we've seen this time and time again. What you really need are great earnings, and you need a great future forecast, and that's what we're seeing. So September and October typically have a little bit of seasonal weakness, and we have seen some choppiness over the past few weeks, which is to be expected around this time of year. But it does seem like when you look at earnings so far, they've been better than expected, and that's propelling the market higher. That's what we've seen so far, even this month.
Ryan Payne, you and Chris agree in overall, strategy. Earnings, though, Ryan, we're going to be getting, of course, a lot of these big names, and then you still got the government shutdown to deal with.
Yeah, 100%. And I agree, things are overvalued historically. If you look at the S&P 500, 22.5 times forward earnings. But I think, what I look at here, Chris, is, and I think markets are going to continue to go higher, especially with the Fed cutting rates here. We have a lot of liquidity out there. We know earnings are going to be really good. But if I look at Apple, for instance, okay, Apple at all-time record high trades at 31 times forward earnings. Maybe they're going to have 12% earnings growth this year. You go back 10 years ago, that stock traded 10 times forward earnings, and it had 30% earnings growth. So you get to a point where, are we paying way too much for these growth stocks? When we look at the valuations that they have and the earnings growth that they're going to have, it's a lot less than it used to be. Which, when I look at my client base, my philosophy here is diversify. There's lots of places to put your money. That growth trade is getting long in the tooth, and you're paying a lot more for growth than you used to.
I think that's a really good point. And if you look at the S&P 500, you'll see 40% of the S&P 500 is concentrated just within 10 names. Now, those 10 names might generate a little under a third of the earnings. So it's not to say that you shouldn't be more concentrated in those top 10 names than you are in the other 490. But to your point, I think things have gotten a little bit stretched. And so it is a sign of risk in portfolios. Typically, you can't use valuation as a timing metric, and we don't. But we do agree that you'd want to look for diversification at this point in time because you have so much concentrated in just so few names. And so, for instance, we have looked a little bit more outside those top 10 names. We've tried to diversify across the S&P 500, look a little bit more broadly across sectors, as well as look at other sub-asset classes within equities. So adding some small caps in early July, looking to diversify internationally, and we've done that all year. And we've looked to just kind of broaden out how we're using that international exposure, looking not just within developed markets, but also emerging markets, and just trying to take that investor capital and make it stretch a little bit farther and make sure that you don't have so much concentrated in so few names.
Your thoughts?
Well, I think there's a lot of important ideas there. And, clearly technology it's what's propelling everything forward within society and even within the military. So that's why rare earth metals are so important, and access to those metals and being able to refine those metals. And as we've been talking about all year, China really has cornered the market, not only in access to materials, but able to refine them. So this new deal with Australia is a game changer. It's something that the United States needed to do. We obviously need to develop our own capabilities domestically, but we also need to make partnerships. And if you look around the world, Australia, I think, is the fourth largest in terms of, rare earths reserves. So that's a great strategic partner, someone that we've worked with in the past, and clearly they'd be among one of our biggest allies. And that's a good counterpoint to what's happening within China. China's really leveraging the fact that they have access to rare earth metals that are used in phones, most technology, the military. And so that is a critical point for us, something that we need to develop. And that's why those material stocks have done so well this year, and why that's such a big deal that we've struck that agreement with Australia. We need to do more deals like these, and we need to continue to build out capacity, because that is really the Achilles heel of the U.S. right now.
Chris Zaccarelli, thank you so much. It's good to see you.